I'm going to share 5 hidden mutual funds in this video that most people don't know about. And these aren't your typical large cap, mid cap or small cap funds. They instead follow unique investing styles that are still not that well known in India. And the best part, these funds just haven't given high returns, but they've often done that while taking on lower risk. So whether you're looking to beat the market, diversify, or take your investing game to the next level, this video is for you. Hello everyone, I'm Udayan Adhye and have been licensed in Indian financial services since 2015, first in insurance and then in mutual funds. And so far, I have helped over 1,500 families make better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. So let's set the stage right away. I'll be analyzing these funds, or specifically their indices, based on 3 factors. First up, returns. Then how they have performed against their benchmark, so we'll get a clear idea of whether it's a good or a bad investment. And finally, risk, because why do we want to take on unnecessary risk, right? And for all these ideas, I'll be sharing the exact fund names as well. So the first secret hidden index has returned 42.1% in the past 1 year. So 1 lakh invested in it would have grown to 1.42 lakhs. At the same time, here's what really caught my eye. An SIP in it has generated a 5-year median rolling return of a whopping 24.2%, while its benchmark has grown at 19.1%, which is still high, but the index here that I'm talking about has grown by over 5% more. And that in SIP terms would essentially mean that if you have a 10,000 per month SIP in this index, it would have grown to 58 lakhs in 10 years, while in the benchmark that it tracks against, that would have grown to 42.1 lakhs. Now, the name of the secret index is the Nifty Midcap 150 Momentum 50 Index, and I was comparing it against the regular Nifty Midcap 150 Index. Now, this Momentum Index works on the momentum style of investing. In it, you're not at all focused on a company's revenue, profit, or growth. The only thing that matters is the price of the stock. The famous Gujarati phrase goes, "Bhav Bhagwan che, price is God." So momentum investing is based on one very simple idea. A stock that has been going up for a while is likely to keep going up a little longer. And the same goes for a stock that has been going down. It's probably going to keep sliding in the immediate short term. That's momentum investing in a nutshell. The Nifty Midcap 150 Momentum 50 Index is made up of 50 stocks selected from the 150 midcap stocks in India. And these 50 stocks are the ones with the strongest momentum. Momentum here is calculated through something called as a normalized momentum score, which looks at a stock's 6-month and 12-month price return performance adjusted for volatility. And this index is rebalanced every 6 months. Now you're probably wondering which mutual funds track this index. I'll share that in a moment, but if you want to dive even deeper, I'm hosting an exclusive personal finance masterclass on Sunday 5th January from 4 p.m. to 7 p.m. This is your chance to get 8 proprietary personal finance calculators that I actually use while working with clients, along with learning how you can use mutual funds for your long-term goals like retirement, where to exactly invest for your short-term goals like going for a vacation or buying something that you've been eyeing, including names of funds and how to select them. I'll also be sharing insights on term insurance and health insurance, which also includes how you can get a 1 crore health insurance plan by paying only 10% of the price. A lot more to share. I'm excited about it, and I'm excited also to see all of you there. The spots are limited, so grab your seat through the link in the description and the pinned comment. There are 2 index funds that track the Midcap Momentum Index. They are offered by Tata and Edelweiss. Let me compare the Momentum Midcap Index to the normal Midcap Index to exactly show you how the performance has differed. So here you go. You can see that the 5-year rolling return since April 2005 has been plotted on this chart. And you will notice, right, that the Midcap Momentum Index has almost always performed better than the regular Midcap Index. You can see even during the COVID crash here, the Midcap Momentum Index, the 5-year SIP rolling return was minus 1.1%, whereas the regular Midcap Index was minus 7.4%. Even during the good times, you will see the momentum index has done significantly better, and it's not a magic pill, right? When the markets have fallen, like during COVID, it also did fall, but it fell lower. And you can also see in the past 2 months, the markets have been slightly iffy. Even then you'll see both these indices going lower. But what's again interesting is the consistency of how well it has performed against the regular mid-cap index. Now, if I scroll down and we look at again the minimum returns over a 5-year period for an SIP, you see -1% here for the mid-cap momentum index, -7% for the mid-cap regular index. What is very interesting is the median rolling returns. So they are 24.2% for the mid-cap momentum index, much higher than the regular mid-cap index. And while doing so, we have to again understand risk as well. That was one of the factors that we wanted to look at. That is captured in standard deviation. So the standard deviation for the momentum index is 9.44. For the regular mid-cap index, it is 8.34. So while it is marginally higher than the regular index, it's not higher by a long shot. Especially if you consider the 5% plus returns that the momentum index has generated. And what is even more fascinating is how the returns are distributed. So if you look at this table here, and I know a lot is happening, so just follow my lead. In the momentum index, over 12% returns have been achieved 21.5 plus 66.7% of the time, that is about 87-88% of the time. Whereas in the normal mid-cap index, it is 27 plus 42, which is about 69% of the time. So the sheer consistency with which the momentum index has given 12% or more annualized returns over a 5-year period for an SIP is staggering and very, very impressive. Let's move on to the second hidden index, and this one focuses on small cap stocks, but with a twist. It combines two very powerful investing styles, that is the momentum investing style and quality, creating a unique approach to small cap investing. This index is called a Nifty Small Cap 250 Momentum Quality 100 Index, and here's why it stands out. I know these names can get confusing, but there's a method to the madness. Like for example, this index selects 100 small cap stocks from 250 small cap stocks in the Nifty Small Cap 250 Index. And it uses both the momentum and quality filters. I already told you how momentum investing works, and it's the same here in this case as well. The quality filter, on the other hand, is calculated for each company based on 3 factors. First up, return on equity, which checks how effectively companies are generating profits. Then the debt to equity ratio, which filters out companies with excessive debt. And thirdly, the earnings per share growth variability, which looks at companies with consistent growth over the last 5 years. But after all of this, does it actually deliver better performance than the regular small cap index? Let's actually look at numbers. So the Momentum Quality Small Cap Index has given 35.48% returns in the past 1 year, which means an investment of 1 lakh would have grown to about 1.35 lakhs. On the other hand, the normal small cap regular index would have grown to 1.37 lakhs. So it's almost similar. But if you've been watching my videos and are a friend of my channel, you know that I don't like to look at absolute returns because they can be misleading. Instead, looking at long-term SIP rolling returns can reveal a more accurate picture. Now in this case, the Momentum Quality Small Cap Index has a 5-year median rolling return for an SIP of 23.3%, while the regular small cap index grew at 17.8%. Now in actual numbers terms, this means that a 10,000 per month SIP in the Momentum Quality Small Cap Index would have grown to about 54.7 lakhs compared to about 38.9 lakhs in the regular small cap index. Let's once again look at charts and see how they have performed in terms of consistency. So here you go, right? If you again notice, this regular small cap index has almost always, in fact, apart from just the past couple of months or past 3 months, the regular small cap index has always done worse than the Momentum Quality Small Cap Index. And in fact, I want to again draw your attention to the COVID crash and how these funds would have performed or indices performed at the very lows. So the regular small cap index was down minus 17%. This is for a 5-year SIP. Whereas the Momentum Quality Small Cap Index was down only minus 8.7, which again tells you a lot about how risk is managed. How is that captured in the standard deviation? As you may have suspected, the standard deviation of the Momentum Quality Small Cap Index is actually lower than the regular small cap index. So it's at about 9.68. For the regular, it's a little over 11. And in the median rolling returns, even they're significantly higher for the Momentum Quality Small Cap Index, which is eye-opening because that's the dream, right? Lower risk and higher return. And even in the returns distribution, you will see that over 20% annual returns were generated by the momentum quality small cap index over 58% of the time, whereas that was about 37% of the time for the normal small cap index. So again, eye-opening, right? Combining two different strategies, momentum and quality, and then using that filter to invest in small caps. That could be a good idea. Towards the end of the video, I'll be actually telling you how to practically potentially implement all of these funds that I'm sharing with you. So which mutual funds actually track this momentum quality small cap index? Currently, there is only one. It's the Mirae Asset Nifty Small Cap 250 Momentum Quality 100 ETF fund of fund, and the data that I shared with you earlier has been backtested and verified by the National Stock Exchange since April 2005. And this fund, the Mirae Asset Fund, was launched in February 2024. All these funds, all these styles of investing are relatively new in India in terms of actually being able to invest in them. So a lot of these funds don't have a very long track record, but because the index data has been verified and because they follow rules and because all these are index funds, it could still potentially warrant considering them in your portfolio. Now let's move on to the third hidden index. It has only 20 stocks in it, and it focuses on the classic investing style of value investing that was popularized by Warren Buffett and his teacher Benjamin Graham. Now, value investing is a very broad term, especially today, so I'll tell you exactly how stocks in this index are picked. First up, the index is called the Nifty 50 Value 20 Index. It looks at India's top 50 largest stocks, that's the Nifty 50, and from within it selects just 20 stocks based on value investing metrics. Now these are return on capital employed, the price to earnings ratio, the price to book value, and dividend yield. So again, how has this particular index performed? In the past 1 year, the Value 20 index has delivered 29.04% returns. That means 1 lakh invested in it would have grown to 1.29 lakhs, while in the Nifty 50, that would have grown to 1.19 lakhs. But let's again look at rolling returns, which show a more accurate picture of how these particular indices have performed. The Value 20 index has a 5-year median rolling return of 16.1% compared to 13.8% for the Nifty 50. So in money terms, a 10,000 per month SIP in the value index would have grown to about 35.2 lakhs compared to 30.8 lakhs in the regular Nifty 50 index. Let's again see how the two have performed for a 5-year SIP on a rolling basis. So here we go, we're looking at data from 2009 and we're looking at a 5-year SIP rolling return data. So if you notice the Value 20 index, it has done better than the Nifty 50, not every single time, but for long periods of time. So the mid 2010s, then after the 2020 crash, the value index has done very well. Sometime in the middle, both were competing very closely with each other during this period. During the COVID crash, the value index actually gave positive returns for a 5-year SIP of 1.42, whereas the Nifty 50 was down -4%, which is again very telling. And if we again scroll down to look at how the standard deviation and median rolling returns look like, the standard deviation is marginally higher for the value index at 5.28 versus 4.2. Again, the difference is very low. I wouldn't read too much into it, especially considering that the median rolling returns are again higher by over 2% for the value index. And if you look at again the return distribution, how many times have you gotten over 12% annual returns over a 5-year period? It is about 66% of the time, 67 for Nifty 50, whereas the same thing, right? Whereas the same thing for the value index is about 76-77% of the time. So again, that difference is present, and you may wonder, right? If you're getting again higher returns at more or less the same risk, then again could warrant the consideration to have this in your portfolio. So which mutual funds track this particular index? Currently there are two. There is one by ICICI Prudential and the other by Nippon India. Let's now move on to the fourth hidden index, and this one takes momentum investing to a completely new level by covering stocks from multiple market caps, that is multiple size stocks. It considers the entire Nifty 500, that is a universe of 500 stocks, and from within this 50 stocks with the highest momentum score are selected to be a part of the index. This index is called a Nifty 500 Momentum 50 Index. So if you notice, there is again a method. Nifty 500 is the universe, and momentum is the style, and 50 is a number of stocks in this particular index. So how has this performed? In the past year, the Momentum 50 index has delivered 42.18% returns compared to 26.16 for the Nifty 500. This means 1 lakh invested in it would have grown to about 1.42 lakhs, while in the broader Nifty 500 index, that would have grown to about 1.26 lakhs. Now let's look at 5-year rolling returns for an SIP since 2005. So the Momentum 50 index has a 5-year median rolling return for an SIP of 20.9% compared to 14.1% for the Nifty 500. And in money terms, a 10,000 per month SIP in the Momentum 50 index would have grown to about 47 lakhs compared to 31 lakhs in the regular Nifty 500 index. Let's again compare the performance and consistency. So if you notice, the Nifty 500 Momentum 50 index has again almost always performed better than the regular Nifty 500 index. There was a time in the early 2010s when that wasn't as true, where the performance was very similar, but throughout, right, ever since then it has been a clear winner. Even during the COVID crash, if you notice, the fall of the momentum index was far lower. It was minus 1% for a 5-year SIP, whereas for the Nifty 500, it was minus 5.7%. Now let's look at the standard deviation, which will tell us a little about risk about both these indices. So it is 9 for the momentum index, whereas for the regular Nifty 500, it is 5.49. So it's much higher than the regular index. You may argue that the median rolling returns of the Nifty 500 and the Momentum 50, there's a huge difference there of over 5%, in fact over 6%. So the higher standard deviation could be a good idea, but I have a slightly different take on this. So the entire idea of the Nifty 500 Momentum 50 index is that it looks at 500 stocks, right? That includes large cap, mid cap, small cap, which could be beneficial, which is why we see the higher performance, because in the Nifty 500, a large part of the portfolio is still allocated towards large and mid caps. But in the Momentum 50 index, because stocks are selected based on the momentum score, there could be a possibility where a large part of the allocation, or a higher at least relatively part of the allocation, could be more in mid and small caps. So I have less visibility on how much of my portfolio is in large, mid and small, which is something that I don't really like. So you can consider this particular index, but you have to be aware that it carries significantly higher standard deviation. That means the portfolio is just more volatile. It will keep moving up and down a lot more than other kinds of funds. Having said that, which mutual funds track it? Currently, Motilal Oswal and Nippon have index funds in this space. Now let's move on to the final hidden index of the video, the fifth one, and this one focuses on quality mid-cap stocks. It's called the Nifty Mid-Cap 150 Quality 50 Index, and here's why it is special. Now, mid-cap stocks are often seen as the sweet spot between high-growth small caps and stable large caps. But this index takes it a step further by handpicking the 50 highest quality mid-cap stocks from the universe of the 150 mid-cap stocks in India. This quality is based on the same quality score that I spoke about earlier. So how has this particular index performed? In the past year, the mid-cap quality index has delivered a return of 28.6%. So 1 lakh invested would have grown to about 1.28 lakhs. While in the regular mid-cap index, that same amount would have grown to 1.33 lakhs. So there is a difference of about 5%, but let's look at rolling returns to get a more accurate picture. And this is where the difference is even closer, because an SIP of 10,000 per month in both these would have grown to roughly 42 lakhs. There's actually just a difference of about 15-20,000 between the values of these two indices. Now, before you discount the quality mid-cap index, let me show you the standard deviation of the two, right? So if you notice, the mid-cap quality index has a median rolling return for a 5-year SIP of 19.3%. It's 19.1% for the regular mid-cap index, again very similar. But if you look at the standard deviation, it is again much lower in the quality index, which is surprising given that, again, they have delivered the same kind of returns. Then let's look at the consistency of returns. So here we go with the mid-cap quality index. Up until 2018, it was almost always doing better than the regular mid-cap index. Then after that, till about 2020, 2022, it was very closely linked to the regular mid-cap index. And since then though, since 2022, you can see that its performance has actually gone down compared to the regular index. And then again, if you look at the COVID crash, the mid-cap quality index fell by only -1%. This is for a 5-year SIP, whereas the regular mid-cap index fell by -7.4%. And right now, UTI and DSP have index funds that track it. Now that you know about these 5 hidden indices and the mutual funds that invest in them, how can you go about adding these to your portfolio? I'm going to share one simple idea. You can consider allocating a total of 20 to 25% of your portfolio to 1 or 2 funds amongst these based on your risk appetite and financial goals. For example, a momentum fund could be paired with a quality focused fund, and this can create a balance between 2 different investing styles where you both get growth and stability. Now, I personally believe that the momentum style of investing is not as popular and common and is not as present in most regular mutual funds in India. So adding a momentum index fund could actually be a good idea. By doing this, you're not just diversifying across market caps, but also across different investment philosophies, which is a great way to strengthen your portfolio and improve long-term returns. But don't forget that the key is to align these funds with your investment goals and risk tolerance, because at the end of the day, all these funds that I have mentioned are investing in the stock market. So their values will go up and down, and you should at least have an investment horizon of 6 to 7 years if you're thinking of investing in them. That's it for today. If you like this video, then check this one out where I talk about 5 more hidden mutual funds that you can think about, and I'll catch you in the next one.